Index funds quietly control the stock market in a way that feels invisible to most investors. Yet their influence has grown so large that it now shapes how prices move, how companies behave, and how capital flows across the global economy. And to truly understand this power, you have to forget the idea that the market is still driven mainly by stock pickers, analysts, and bold traders making individual decisions. Because over the last 2 decades, the structure of investing itself has changed, shifting from active decision-making to automatic allocation, where trillions of dollars now move without asking whether a stock is cheap or expensive, innovative or declining, well-managed or poorly run, and instead flow purely based on index membership and market capitalization. Index funds were originally created as a simple, low-cost way for average investors to capture overall market returns, not to control the market, but as retirement accounts, pensions, ETFs, and long-term savings increasingly adopted passive strategies. Index funds slowly transformed from a background utility into one of the most dominant forces in modern finance, because every dollar that enters an index fund is automatically distributed across a predefined list of companies in fixed proportions, meaning that money does not choose companies based on future potential, but reinforces existing winners simply because they already occupy a larger weight in the index. And this creates a powerful feedback loop where size attracts capital and capital increases size, making the largest companies even larger over time. When an investor buys an S&P 500 index fund, they are not making a judgment about Apple, Microsoft, or Amazon individually. Yet those companies receive massive inflows because of their weight. And when millions of investors do the same thing month after month through retirement plans and automatic contributions, the result is a constant stream of buying pressure that pushes index heavyweights higher regardless of valuation, which subtly changes how stock prices behave. Because prices are no longer determined solely by opinions about future earnings but increasingly by mechanical flows. This effect becomes even clearer when companies are added to or removed from major indexes, because inclusion often leads to an immediate rise in share price as index funds are forced to buy the stock, while exclusion can trigger sharp declines. Even if the underlying business has not changed, revealing that index membership itself has become a market signal powerful enough to move prices independent of fundamentals. Over time, this dynamic concentrates market leadership, as capital keeps flowing to the same group of mega-cap companies while smaller firms, startups, and companies outside major indexes struggle to attract attention, liquidity, and investment, creating a market structure where innovation does not always receive capital first, and where being big matters as much as being good. Beyond price movements, index funds also quietly control the stock market through ownership, because firms like BlackRock, Vanguard, and State Street collectively hold significant stakes in thousands of publicly traded companies, often making them the largest or among the largest shareholders, which gives them enormous voting power over corporate governance, board elections, executive compensation, mergers, acquisitions, and long-term strategic decisions. And while these firms describe themselves as passive investors, their ownership is permanent and their votes are anything but neutral. Because when a handful of asset managers consistently vote on behalf of trillions of dollars, they shape corporate behavior across entire industries, influencing how companies think about growth, risk, dividends, sustainability, labor policies, and shareholder priorities, even though this influence happens quietly through proxy votes rather than loud activism. This concentration of ownership raises important questions about who truly controls corporations, because while individual investors technically own shares through index funds, the practical power is exercised by fund managers who decide voting policies, engage with company leadership, and set governance standards, meaning that control is centralized even as ownership appears diversified. Another major but often overlooked way index funds reshape the market is through their impact on price discovery. Since traditional markets relied on active investors analyzing financial statements, assessing management quality, and debating future prospects to determine fair value, but as more money moves into passive strategies, fewer investors are actively challenging prices, which can allow mispricing to persist longer, inflate bubbles in popular index stocks, and reduce incentives for deep fundamental research, especially in smaller or less visible companies, because when active managers underperform indexes, investors withdraw capital, further reinforcing the dominance of passive funds and weakening the role of active analysis. This creates a paradox where index funds depend on active investors to set prices, Yet their growth slowly undermines the very mechanism they rely on, potentially making markets less efficient over time. The risks become more visible during periods of stress because index funds change how markets behave in downturns, as selling pressure becomes synchronized, meaning that when investors panic and pull money from index funds, selling occurs across all constituent stocks at once, regardless of individual fundamentals, increasing correlations and causing broad, rapid declines that can overshoot economic reality, which explains why modern market crashes often feel sudden and indiscriminate, with good and bad companies falling together simply because they share index membership. Liquidity can also become strained during extreme events, especially in ETFs, where underlying assets may not trade as smoothly as the fund itself, adding another layer of systemic risk that did not exist in earlier market structures. Yet despite these concerns, index funds continue to dominate because they offer undeniable advantages for individual investors, including low fees, diversification, simplicity, transparency, and strong long-term performance relative to most active strategies, making them an effective tool for wealth creation even as they reshape the market's foundations. This dual nature is what makes index funds so powerful and controversial at the same time, because on one hand they democratize investing and reduce costs, but on the other hand they concentrate capital, influence corporate behavior, and subtly guide market outcomes without making explicit decisions. The quiet control exercised by index funds is not about predicting which company will win next year or timing market cycles, but about controlling the plumbing of the financial system itself, deciding where money flows by default, which companies receive constant support, and how markets respond to growth, decline, and fear, meaning that the future of the stock market will be shaped less by individual opinions and more by the structure of passive investing. And understanding this shift is essential for anyone who wants to truly understand how modern markets work. Because while index funds appear boring and hands-off on the surface, they have become one of the most influential forces in finance, quietly redefining what control looks like in a world where participation itself has become power.